Well, first and foremost, thank you to Darius. I thought that was very informative and very helpful and great insights provided there.
Thank you, Mark.
So thank you for that.
Appreciate
And it certainly set the basis for our conversation because we're going to be talking about, as Marty indicated, alpha alternative strategies, and it's an area that's very interesting. You know, how can you do well in this market? Marty couldn't stand what I was saying, so he muted me. Anyway, I've got some great people who are really the brains of this, and you know, we've got Cory Reeder here. He is a chief investment officer for an asset manager, and Cory will explain that very generic name, asset manager. We have Tyson Halsey, managing member of Income Growth Advisors, and Eveline Gerck, who is an advisor for family offices. And really what she does, she sits on a couple of boards for some funds, as well as some family offices investment committees. So she's got a wealth of information and it's going to be great fun having this panel. I've worked with all these people before on these panels. We always have a great time. So my warning to you is strap yourself down. This is going to move quickly and it's going to be a lot of fun because we get in the weeds about everything. My name is Mark Heil. I've been involved in alternatives since the mid-90s and marketing, capital raising, fund administration, and also helping people to invest from their retirement funds into the alternatives world. So I've seen the business from many different angles. It'll be complemented by these people sitting around me today. To be clear, this panel is for educational purposes and not to be considered tax, legal, or financial advice. Any opinions offered are those of the commenters alone and not reflective on their employers or their businesses or however you care to phrase that. For the next hour or so, we're going to have a discussion up here. It's going to be going back and forth. Tyson is going to present a few slides and talk about some things, but for the most part, it's going to be a discussion among three people. And we invite you to be part of that. The only thing I ask is, you know, time is valuable as always. So the shorter your comments or the shorter your points, the better off we all are. Marty, were you going to add something?
Mark, yeah, you've got a full 50 minutes, so feel free to take that time.
No, plan on it. It still won't be enough. So,
gotcha.
So with that, I probably would like to take this time now and have our panels introduce themselves and give you their background. Eveline, I'm going to start with you, and I want to just give everybody a little heads up. Eveline's feeling a little under the weather today, but she's a trooper and said, you know, I'm going to be on, Mark. We're going to make this go, and looking forward. She brings great insights to this. So, Eveline.
Hi, Mark. Yeah, believe it or not, I have COVID-19, so and just tested positive. So my voice is really bad. You know, mostly what I have been doing the past few years is I sit on boards of venture capital funds. I was a general partner for a private equity fund for many years, and one of them was funded by 4 very large families in the US and one in Italy. So after that, I was invited to be in the board of funds. So today what I do, I'm in the board of funds. I also sit on boards of family offices. And the funds go, as I was talking with Mark, we can talk about today. I'm associated with a fund that we call a hedge fund, but it's really like a public markets strategy. So I'd like to talk about that later. I also with 3 venture capital funds, 2 early stage and 2 later stage, and always as an advisor helping them to find transactions, also to bring new investors to our platform. And that's what I have been doing the past few years.
Fascinating. Tyson, why don't you take a few minutes and tell people about yourself?
Hi, I'm Tyson Halsey. I'm 62, so I have some gray hair. I went to Duke. I studied engineering and economics. Engineering was too difficult, so I switched over to economics. I started working on Wall Street on the New York Futures Exchange, so I have a lot of option and derivative initial experience, trading experience, run a couple of hedge funds, run a few RIAs. And I also was a rare broker in that I got the CFA designation. So What I think I bring is that I understand the economy, I understand valuation, and I also understand markets. And so I try to put all that together, and I will when my presentation comes up. I'd also
Excellent.
say I won the USA Today CNBC National Investment Challenge and been on CNBC, and that was leveraging kind of options with really very focused work, in biotech. And I tend to be somebody who's more inclined to look for the big winners, though today you'll see me talk about playing it safe.
So you're basically a rookie, is what you're saying, right? Just new to the market.
Yes.
No, we're great to have your experience here, and look very much forward to your presentation in a couple of minutes. Cory, why don't you take a few minutes and introduce yourself as well, and give us an idea of what's going on.
Yeah, so I guess right off the bat, everyone, oh, there you go, my video froze. Everyone knows I'm a father, as my daughter just walked in here and need a little help with something. But that's the beauty of the world we work in and live in today, is that you can work from anywhere at any given time. So, but my history, I think I saw on Darius's presentation, came in late, but as he flipped through, I saw a football reference there. So it seems like he may have been an ex-athlete. I'm 7 feet tall, originally from Australia, played basketball professionally for 9 years, college here in the US, but then switched over in 2005 into the financial arena. Started out Smith Barney, up through Morgan Stanley, and then 2017 left out, and we run our own wealth management firm. Up until recently, we're still in the midst of some changeover and refocusing of what we're doing. But effectively, I've been a fund manager for 18 years. Think of them as hedge funds for your average investor. So, it's the funds that I've run have been open to all levels of investors, as opposed to you're accredited that the hedge fund space only or solely deals with or is allowed to deal with. And so I guess there's going to be lots of stuff for us to touch on, but I guess that'll be it for right now.
Yeah, so your business that you're working is actually transitioning, right? And it's morphing into something new, right? And so during this cocoon phase, you have to be a little stealthy.
Right. Yeah. So it's more, I'm moving more onto the just being a fund manager side, as opposed to the day-to-day interaction with individual clients and such. But then we have a specialty, we've been dealing with since 2017, but we're right on the cusp of a partnership that we're going to be rebranding and announcing under. But that's, how do you say, tax benefited structuring and applications. If that doesn't raise any red flags with the IRS.
So Tyson's in a couple of minutes going to put up some slides and talk to us. But before he does so, I just wanted to have a quick conversation about alternatives alpha strategies and what it means, so we're all on the same page. A couple of months ago on Eveline, when I were on a panel, we had Charles Friedberg, who was on a panel, and he has a sustainable fund. And Charles was arguing that, private equity, hedge funds, and venture capitals were no longer alternative. So I think just sort of at the level set and get everybody on the same page, let's talk about the characteristics and what is an alternative alpha strategy. And Cory, I'll kick this off to you. You're usually a lot of fun and have some great insights, so why don't we start there?
Well, I mean, the term alpha, it's, you look up a definition of it on the dictionary, and you can read through all the different applications in different arenas, but bottom line, it's just, it's outperformance. It's bigger than, better than, brighter than, anything else around that's offered. But, with what I've always done, the Wall Street in general is buy and hold. And I'm the antithesis of that, where buy, hold, and sell. So, there's an old saying, it's not what you make, it's what you keep. So, with what we do with the fund management, it's actually, avoiding and mitigating the downside losses as far as how we get the outperformance. If the markets go down and we don't, then obviously you get a couple of those runs. Maybe the easiest thing, I'll give just a quick share. so that people can see visually what it is I'm talking about. So you can see that, right?
Not yet.
Started screen sharing. There it is. Yep.
There it is. Yeah. So very simply, I mean, this one, it's 100% U.S. equity fund. The orange line is the performance of the fund. The blue line is the equal weight U.S. market. So we started this fund in August of 18, but that was the crash into Christmas of 2018. There was the COVID crash, and then the recovery, and then of course the drop that's gone on, but started back at the end of 2021. So head to head, the U.S. fund is up. This is as of April 30th, but that's a 27.5% beat head to head, with the U.S. fund up 23%, while U.S. markets are down 4%. So it's the difference is created not by knocking the ball out of the park. It's about avoiding the losses. And we've been on a panel before where someone came on after me and they said, well, you can guess once or twice. And well, reality speaks different to that, is that's once, twice, 3 times a lady. And that's what it does. It's not timing the market. The market can time you as long as you have an applicable strategy that works every time. So that's more to the specialty, and of course our even our conservative fund going head to head, half stocks, half bonds, but it's about not losing when different asset classes go down. So that's how, as far as the specialty of what I've always done, it's about preserving and protecting client wealth and mitigating losses. I know the word protect is a no-no in the industry, but preserving client wealth and mitigating losses. And if you do that on a repetitive basis, then clients are doing great. But obviously, there's a whole smattering of different arenas. You've got de-dollarization going on. You got the BRICS Bank. You got the alternative SWIFT system and payment system around the world. People moving away from U.S. treasuries as global reserve currencies, and the ill effects that can have on the dollar moving forward. But there's always catalysts in the markets as well, and across various spectrums, as far as what is going to make something outperform relative to the market or the generic S&P or whatever you want to use as your benchmark. So you always have to look at what those catalysts are that are coming down the pipeline, and where they apply and why they're important.
Tyson, I'm going to toss this over to you. And we've heard outperformance is a key characteristic from Cory. And what I want to know from you is, is there a length of time that this strategy has to last in order to be considered an alpha alternative, or is it something that can be here today, gone tomorrow? What are your thoughts on that?
I think that Marty came up with his own term, so I'm not sure whether it falls into a particular definition. I think alternatives typically are things other than stocks and bonds, which include real estate, commodities, and alternative vehicles, which are hedge funds or whatever. How long you own those really is not duration sensitive. A hedge fund, such as something like what Cory has, which does hedging so it doesn't have a significant drawdown, is an alternative. And I don't really think of that alternative being an alternative for a certain period of time. By virtue of how it provides a non-correlated return, I think is what makes it an alternative.
Eveline, do you think for an asset for something to be considered an alpha, alpha alternative strategy, it needs to be actively managed?
Yeah. So I agree with Tyson that the definition of alternatives is anything that's not straight stocks and bonds. And so I understand that Cory is more in the ETF investment side. So the funds that I'm involved with, they are in the venture capital side, which that's a strategy that you need to stay long-term for you to have the capital appreciation. It's highly volatile. And you don't have the concept that you can have capital appreciation at the same time that you have capital preservation. So I'm in one fund, which is a seed stage that is very aggressive and has unicorns, and the things like to have the capital appreciation. So whoever invests in that fund is going to be a more aggressive investor. Then I have another fund like the K funds, which were the third one, that is only designed for family offices. So they're much more cautious, and they only go into later stage. And in companies that they understand that the technology, they can understand it is not something like crazy, even though they're invested. We have in our portfolio companies like SpaceX and Chewy. I mean, Chewy can understand, but SpaceX, at the beginning, nobody had really had the view that this happening. Or you knew the view, but, was a risk for you to really say, I'm going to have capital appreciation as I do capital preservation. But it happened that, is doing quite well. So right there, that's the active management of the fund manager, in this case, Gary Post, who really knows how to choose those investments that they look risky, they are later stage, but he knows that's going to be in that profile. So it really goes with the talent of the fund manager. Then I go to the public markets, and that's a new fund that's coming out. It's called GodaFoss. It's an interesting name, GODAFOSS, which is, I believe, Finnish for waterfall. But that fund was created from one fund manager that was investing basically his family wealth. And in 5 years, let's just use like a number as a parameter. You have like 100 and you become with like 2 billion. So not going to, percentages and comparisons to indexes, because I think that the fund manager, I think he's even in San Francisco in this conference today, he can share with people. But what is interesting there is that like Cory, they only invest up to like 50, ETFs. He invests from 5 to 10 stocks only. And so it takes a lot of thinking. And they are only consumer discretionary information technology. So I already investing a little bit, still like starting the fundraising for this fund. But the performance of this fund is being exactly the same, mimicking the family office. So then you have S&P that if you just get, S&P in the long term, you can have like a 30%, a 50%, and this guy gets like 50% consistently every year or more. So right there is the talent that Cory has, the talent that Tyson has, the talent that Adam has. So primarily public markets, it needs a lot of talent, and in private too. So it's all about talent.
I think you got it right there. So far what I've gathered.
Hey, Mark, can you give me a second here? Mark.
Sure.
Hey, Mark, I just want to clarify something. So when I talk about alternative alpha, so I'm harkening back to the origins of the hedge fund space, really, which are that if you look at the first generation of hedge funds, they were called like all-weather alpha funds. They made money all the time, right? They were constructed to outperform at all points in time. So that's what we're trying to get back to is what are the number one, what are the strategies that you can employ today where you will make money in a downturn, and what are the strategies which seem to be longer lasting? What are the better managers, et cetera, et cetera? And that's why. And I don't know that Tyson said I didn't make it up at all. It's a 40-year-old term, right? It's just that it's because of hedge fund marketing, which has been more about asset gathering over the last 20 years or the last 10 years, since all the leverage beta got pushed out in 2008.
Well, you're sort of answering my question. What happened to those all-weather alpha funds is they don't exist because everybody sort of went into that strategy, right?
Well, two things. One, they got disintermediated, right? The strategy got disintermediated. That happens all the time, right?
Yep.
And the second thing is those strategies became family offices, right? So like Soros has his thing with reflexivity, and Stevie Cohen is a huge market maker, and I guess that the guys that used to be out of Chicago are now in Miami have done tremendous. Citadel, right? They're the best performing hedge fund of all time, right? And then you've got the guys who are the macro quant guys, right? So anyway, that's my comment.
Yeah. No, I'm glad you threw that in here because I think I sort of had a feeling that's what you're driving towards, but I didn't know for sure. Now I have the answer. But I will quickly want to...
Just for the sake of something that Mark said, Marty. So he asked if the talent of the fund manager was under consideration. If you really look, you had a lot of quantitative funds, hedge funds, that went under in the past few years. So even with AI and everything, I think that the talent of the fund manager is always going to be there.
Good comment. I was going to say, so
Well, I mean,
outperformance,
Eveline,
active management do seem to be some characteristics that have been spoken about. Do you disagree with that, Marty?
A talented fund manager in the right space matters. If you're in the wrong space, you're just like who's that guy, John, whatever his name was, who went up against the machine that could put more nails into the railroad tracks. John Henry, right? So you don't want to be John Henry, right?
Well, my last point I was going to bring up here is, and characterizing this is really contrarian or inefficiency that drives the alpha. And so is it inefficiency or being contrarian? What are your thoughts on that?
I would think that applying inefficiencies would come back more to what was it Darius earlier, macroeconomic applications and thought process, whereas contrarian is more of a technical play as far as what's going on, and micro maybe, but micro to the extent of what the assets have done, and where they stand. I mean, look at, and back to Marty, what he was just saying too, early on when I was introducing, I mentioned things like, catalysts for certain areas to outperform, which does lead to what Marty was mentioning, is that being in the right area at the right time to benefit from said catalysts that could push different asset classes around in various directions. So, I mean, look, look at treasuries. I mean, treasuries have always been a safe haven flow asset. So, they lost half of their value from their peak in 2020 until the recent lows, about 8 months ago. So, with oncoming recession, depression, whatever it is that hits, at some point the Fed will flip-flop, and when they start cutting rates, if raising rates killed treasuries, what do you think cutting rates is going to do? That'll also send treasuries in the other direction. As they start printing money ad infinitum, that'll kill the US dollar. Well, anything denominated in US dollars, you've got commodities, you've got precious metals, you've got things outside of the stocks and bonds arena. There's cannabis out there, which had a great run after the 2020 election, but then, there was no meat on the bone. There was no follow through on it. But at some point, if there's national legalization across all states and across the country, then there could be political implications or catalyst for certain assets to take off. So, that's where it then comes back. Being contrarian is sort of, really getting back to being a value investor. Contrarian, buy at the lows, don't buy at the highs. So there's your contrarian application. Look for assets that maybe have been out of favor for medium to longer term. Commodities is a great arena when you look at long-term applications of where commodities across the board are compared to the stock market. So there's a couple of different thoughts and areas. And I know
Mark,
that
I just want to put in one point for what Cory was saying. I'm going to throw in another intangible variable, which is the velocity of misinformation or noise
from the government.
So much of it can really take you in the wrong direction, but still make money. So, I mean, a great point about cannabis is that when nationalization happens, there's going to be a lot of bankruptcies because a lot of firms are over, they've just over capacity. And if nationalization happens, a lot of those firms will suffer, right? So, but I think that somebody said that Oregon has 10 times the amount of cannabis than California per capita.
Well, that was it.
But again, it's Oregon, right?
That was the new gold rush, and everyone overinvested in it, thinking that there was going to be follow-on and pure legalization, and didn't happen.
But think about it. I'm just saying that there have been many people who have ridden misinformation or noise to great heights, and there's actually all kinds of noise-making machines on the internet. I've never seen a greater noise-making machine than the crypto guys who are just expert at just promoting. So, I mean, it's amazing.
We'll get there a little bit later on with the whole
I'm just saying. So I mean,
but...
so that's part of alpha too, is being able to see a trend. So
yeah,
anyway,
no, absolutely, and that's why I was asking about duration and for a few years now we've been talking about the special situations market and what that might be. And obviously it hasn't come to fruition, as you pointed out earlier, Marty. So how soon does that have to become begin to achieving the results we expect? Cory, I just want to do one little last point, then I want to flip it over to Tyson. And Eveline a couple times spoke about your ETF strategy with your firm. Maybe you just want to clarify how that works, because you do actively manage the ETFs that you invest in. And
Correct.
I think you should make that a little bit clear to everybody how that works.
Yeah, so I mean, each one of the funds, I mean, there's crypto funds, there's cannabis, there's commodities, precious metals. So it's not just the stocks and bonds arena, but their ETFs are the underlying vehicles, but then it's actively trading in and out of those underlying positions within the fund, which is what then creates the outperformance, catching the upside, but then avoiding the downside on each individual position in each one of the funds is what the strategy is ultimately aiming to apply. I will hark back to Marty, talking about misinformation. Isn't that what the stock market has always run on? Buy the rumor, sell the news. It doesn't matter what the rumor is. You just buy it anyway. Misinformation, good information, you just run it and then you sell it and you make a profit. That's stock market 101.
Yeah, something that's really intriguing from that comment is that I run into people every day who are fantastic entrepreneurs. And I have to say, I run into some people that are immigrants from Asian part of India or South Asia, who are the most amazing bootstrappers in the United States. And they have such fundamentally sound companies, and they're just cranking out profits, but they're private, right? So you have to kind of differentiate between who are just great performers who never hit the market and who are never in the public markets versus, so yeah, somehow you have to get a measure and understand. So.
And yep. I will say there is a newer application for non-marketable securities and creating alpha there, and that is taking the tax sting out of the process. And we're not talking about IRAs, we're not talking about pension plans or 401ks. They're insurance wrappers, private placement life insurance, which people have probably been hearing more about. This is something we've been utilizing and working on our other side, and where we're redeploying our focus and efforts. But those sorts of wrappers, you can take your venture capital, you can take your angel investing, your real estate, your crypto, your precious gems. I mean, any asset class under the sun, you can have those inside these wrappers. So now your returns, either on income or capital gains, buying and selling, is captured inside that insurance wrapper, just like a whole life or a variable life. So now you've taken the tax burn out of, things like what Eveline does for investors. You do some of those non-marketable security or asset arenas in a tax benefited wrapper, then you're automatically creating more alpha because you're not paying taxes on any of those gains or income that you're getting from those non-securities market types of investments.
There's the government there, getting it out of the picture. I love it. Tyson, you're up. Take us away.
All right, I'm going to share a screen. And
please do.
There it is. Alternative alpha strategies. Does everyone see that? All right, Mark, if you
see it, all good.
All right. So are we in a new bull market, or is this a last hurrah? I think that the most important thing to understand when looking at investing today is that for the last 14 years, we have dealt with abnormally artificially low interest rates. And what that has done is created bubble valuations in stocks, bonds, and real estate. And another factor that we have to put together is what's going on with the economy. A lot of people have been anticipating a recession because of the backup in interest rates, because historically that produces a recession, but we've had very strong consumer data. 70% of the GDP is the consumer, and the consumer keeps on spending. And Darius did a great job showing that consumers still have plenty of money. Also, employment has been very strong. So we really have not seen the sort of rollover in earnings. But then there's one third factor I think is very important right now in the market, and that's, you look at companies like NVIDIA and tech and AI, we're sort of having a irrational exuberance moment as it relates to tech and AI. So a couple of weeks ago, we saw NVIDIA take off. I remember 1986 reading Barron's, and Paul Tudor Jones, a great commodity investor, said, any parabolic move usually ends badly. And that advice has always been good to follow. And looking at NVIDIA, that stock has had a massive rally. And, sometimes that's animal spirits, things getting ahead of themselves. And, to use Robert Shiller or Alan Greenspan's expression, it is irrational exuberance. And because of the size of today's mega cap tech stocks, we've seen a long-term parabolic move in Qs, and it's run up recently. And the question is, does it continue to push higher? And to a lesser extent, the S&P, pulled back. It's gotten a nice lift. But in my mind, the question is this a right shoulder and things are now going to roll over? And just to drive down the point that tech has done incredibly well, the S&P tech sector is up 41% this year. And here are a couple of tech stocks that we all know among the Magnificent Seven, up 40 to 100%, 133%. And another thing that I think should get people cautious is you look at VIX, and VIX is a good sentiment indicator. It is the option volatility index, which effectively tells you what the price of insurance is. And when it's low, people aren't buying insurance. People want to buy insurance right before they take their car on a long ride, or they hear there's going to be a Cat 5 hurricane hitting in 2 days. And the time to buy insurance really is buy it when it's low. You don't buy it when it's high. I think that going back to the economy and what my work has done, one of the great models that I like is something called the risk premium model, or the Fed model. And what that does is it compares the valuation of the S&P to the 10-year Treasury. Actually, it's the earnings yield of the S&P 500 to the 10-year Treasury. And right now, it's actually not bad. But I think one of the kind of subtle things that I picked up, and this chart below, I get it from Portfolio 123, a great software I use, is if you look actually at the peak in 2000 here, the tech bubble, in the aftermath of it, the earnings line declined almost 50%, again during the great financial crisis, again during 2020, during the COVID crash. And then what we expected was earnings are rolling over, and they were rolling over, and everyone was talking about a recession, and everyone was very bearish. But lo and behold, the earnings on the S&P 500 actually started to move up. So you combine that with the fact that people are talking about, maybe we won't have a recession, and we're in a new era because we're going to have so much efficiency, that there is this enthusiasm, which I think historically is a good time to be cautious. So let's use one good measure. Robert Shiller won a Nobel Prize. He would use the CAPE ratio, which is the S&P PE ratio on a 10-year rolling basis, or a 10-year basis. And what you have now today is a PE of 29. And, it's below 2000, and it's below where it was a year and a half ago, but it's not much below where it was in 1929. It's above the peak in 1901, 1966. So, and if you were actually to go back and look at where it was, let's say in 1980, when interest rates were up around 15%, 20% on money markets, 15% on treasuries and mortgages, then, you actually had a PE ratio of the S&P 500 on a 10-year basis. It was around 7. And, everyone's like, oh, well, the S&P multiple has really come down to 17%. Now, again, I'm switching between a 10-year and a 1-year. But the fact of the matter is, we have gotten very used to high multiples. And I think that we are swimming upstream now when it comes to those major assets, which are very tied to interest rates. So basically, my theory or thesis is this: out with the old, in with the new, and particular alpha ideas for people who are active portfolio managers like myself is, yeah, you want to be fading the stocks, bonds, and real estate, and long duration and growth equities, and even the 60-40 allocation. And what you really want to be in is in gold and commodities, high yield instruments, money markets, 2-year treasuries, emerging markets, small cap value stocks, and international markets. And go with a 25, 25, 25 ratio between stocks, bonds, commodities, and money markets. There's one other factor that I think is
Tyson, can I ask you a quick question on that?
Sure, go ahead.
It seemed like Darius's presentation said commodities aren't doing great right now, or did I misread it or mishear it?
And he's absolutely correct. And on a trailing 12-month basis, they have been absolutely terrible. But I also think that he said that, I think that, I won't put words into his mouth, but I think that if you were to listen to Jeff Cory of Goldman Sachs, Jeff Cory will say, we should get a 30% rally in commodities by year end, that we are in a super cycle. And actually, through this whole period of abnormally low interest rates, we created a lot of synthetic financial commodity assets, and they ballooned and everyone owned them. And now that interest rates are going up, it's not as attractive. And you have been getting a lot of liquidation of those financial commodity assets, which has contributed to downward pressure. But if you were to look at oil versus a year ago, it was probably up around 120. It's now 70, almost half. Natural gas went from almost $10 per MMBTU to about 2 now. So those are huge pullbacks in very important commodities. But I think that what we'll see is we've been in a deflationary environment. Now we're heading into an inflationary environment. And it is my call, it's my belief, and I may be wrong, but my bet is we're going to have higher inflation. Commodities will play a role in it. And what he did say was that inflation is not dropping back to the 2% range, which I certainly think is the case. So real quick, I would say that
another question, Tyson. So when you talk about commodities, do you think that picks and shovels for developing commodities will be relevant, like mines and things like that? Or okay.
Definitely. I mean, I'm not somebody who's a purist saying, you have to own these metals or, I think commodities could be, there are different ways you may want to play it. I'll actually touch on a couple investment vehicles, which are, derivatives of that. But I think conceptually, it is an asset class which has produced no good return since about 2015, when oil prices really started to decline
I don't know if it was the Wall Street Journal or something like that reported that Exxon has a new fracking technology, which is even, is a quantum step higher in terms of the ability to frack wells, but it may be relevant in terms of the, energy pricing, issues that we have these days.
It could be.
I think it also depends on which arenas of commodities you're talking about as well.
Yep.
I mean, you start to get into foodstuffs, agriculture, rare earth minerals, even uranium. I mean, nuclear power, of all things, has now become the new green energy.
Well, I think that they're all important. And
there's places for all of them in different areas. Yep. Go ahead. Sorry, Tyson.
Anywho,
Sorry, Tyson.
I would just say that we've been brought up for 40 years and done very well, having a nice risk-adjusted return with a 60-40 asset allocation in pension plans and derivatives thereof. And in this environment, actually, I think that that is outdated because we don't have the tailwind of lower interest rates. We don't have artificially low interest rates. And with higher interest rates, actually, it makes more sense to actually own a commodity now. So I think, and I also say that money market. So right to my picture number 10, Interactive Brokers. I was at home at lunch, 4.58% for a money market. Well, now an 80-year-old doesn't have to go buy some mortgage closed-end fund or a mortgage that, they're going to get prepaid their principal back. And you really are actually starting to get competitive rates, which is really good for retired people, that they aren't going to have to take the kinds of risks that they have in the past. And if I were I am, and if you're asking me, I think that it is not a bad idea right now, before a potential recession, to have 25% in money markets, 25% in commodities, and a much lower stock and bond allocation. And just to talk about some of the derivatives vehicles that are for commodities, is there are a variety of ways that you can get high yields, and I'm just going to mention 4 of them real quick. Energy transfer, it's an MLP, yields about 9.5%. Great management. That dividend yield should grow. I want to be in energy. I want to be in U.S. energy. Another one is the GAMCO Gold and Global Gold and Natural Resource Fund. They're a covered writing fund, so that's where they get a lot of their actual income, but getting a 9.5% yield is attractive. And you combine that with, 9 with the energy transfer. I also think that the emerging markets will do well. And Templeton has been in the emerging markets for 60 years, and they really understand those markets, and they have a fund, and it buys largely sovereign wealth in emerging markets. It yields about 11.25%. And, you start to put together a portfolio of that. And another stock that I own is a company called Antero Midstream. It is a infrastructure play. They own the pipelines for Antero Resources up in the Utica Marcellus. It is a great play on natural gas. And now is a good time to own it. And here you get a yield of about a little over 8%. The management owns a considerable amount, maybe 20, 30% of the stock. And the third one, in terms of an
we need to wrap, so pull this together quick.
I am. And the third
That's right,
idea where you can get some alpha is in gold. And I think that gold goes through periods in an inflationary environment. It does very well. It was up 1,800% in the 70s to the 80s. And from 1999 to 2011, it went up 600%. And now I think gold should do really well, particularly as we've come to the end of a tightening cycle. The dollar will weaken, and I think people are looking for an alternative to paper money.
Great.
So those are my 3 alpha ideas: money markets, high yield vehicles, and gold.
No, and I think they're all very interesting strategies. Although I know we're here on a few minutes left here, but I did want to get into a conversation about AI. And Eveline, I want you to maybe counterbalance what Tyson
Mort, can I hold
said.
on? Any questions from the audience here?
If you have questions, you have to be my eyes and ears, Mort. I can't see them.
Any questions from the audience here about alpha strategies and anything they like in particular?
Somebody put up a question about, somebody asked about copper.
I think, the historical long-term average of the stock market was like 10%, and, alpha would be, for example, getting over that. Given all the shocks that's happening, what is the new alpha number?
So so it's benchmarked by area that you're in, right? So you have to perform against the benchmark. So just, rule of thumb, guys, any thoughts on alpha for the segment that you're talking about? Tyson, what's alpha? I mean,
alpha is just what you said. What's your benchmark? The delta relative to a benchmark. I guess somebody said something about copper. I would say there's a very compelling argument for investing in the new green economy, and copper is, along with lithium and cobalt, are some of those green metals, and mining is an area, along with energy, that I'm very favorable on.
Okay. Eveline, any thoughts on like what's a good number for alpha? I mean, when you look at most alternative funds, they try to perform 15%, but to me, there's a liquidity premium, right? And I guess we never discussed like what's a liquidity premium that you should be having for locking up money for 10 years sometimes, right? So any thoughts?
Yeah, I can talk about that, but I just want to, I'm sorry. I had this throat thing here. I think that, you always look in venture capital funds and private equity, you always wanted to have a 35% return minimum. And most of those funds couldn't return that. You see that how Tiger is having problems to raise capital in the market. Problems. Instead of 6 billion, they raised 2 billion. So I really think that, the alpha in the private market securities, venture capital, private equity, real estate is always going to be superior than if you are in a public market, but you need to be locked there for many, many years. So that's the difference. But I wanted to go back to what Tyson said, going back to AI. The beauty about, and I started in public markets, went to private markets. Today I do private, but also being, helping people in the public. The beauty about private markets is something that Moderator said, which is anticipation. Everything that happens in the private markets hit the public markets 12 to 24 years, 24 months later. And it's like news to the public market, but it's like old business for the private markets. So having said that, I want to talk about 2 things. Number one is the alternative energy. Right now, you have a big fight in the market looking for vanadium, for copper, for lithium, because you have a lot of projects out there with, that even specs that are going to be, that are being built with. I'm associated with one of the projects. I can tell much more, but I'm going to tell is that when this hits the market, you're going to see the shortage of this. And you don't have a market, as far as I understand, for vanadium and lithium that is looking for you to, invest in the commodity space. It has to be something hedged. I don't know how this would be. But then, so that's one trend. The second trend is AI. So everybody's talking about AI, but you see the venture capital funds, primarily in fintech and edtech, trying to divest as quickly as possible for those companies that have content to be acquired by the AI companies that need that content to feed the beast and then have more information out there. For instance, Photomath, which is a math company at Tech K-12, was just bought this year by Google. So why would Google buy a K-12 math company? And why would the math company team up with Google? Because they knew that they would die without AI. And Google is going to bring all the platform behind it. So right now, in the K-12, in the HR tech, all these ed tech markets, you're having everybody's running to find an AI partner, a bigger, broader partner that can develop AI. And it's going to be very evident because it's happening in ed tech. That's the major devaluation. They really went down a lot. So investors are going to lose a lot of money at that. But then we go into health tech, we go into fintech. Those are major areas that you have a lot of M&A activity that is happening right now, happening in the next 24 months. And just scratches the public markets, but is really active in the private markets right now.
Fantastic. Well, listen, we have 1 minute, 30 seconds for each Cory and Tyson to tell us about AI. Cory, what's your 30-second input?
Well, I just saw a report yesterday that said something like 58% of all US CEOs are saying that they believe that AI will destroy humanity within 6 to 7 years. So if you're going to invest in AI, get in there quick and get your gains before that happens.
That's faster than the energy world will destroy us.
Well, it only took about 9 years for the banks to destroy the financial economy after the deregulation happened in 1999. So that's pretty good for AI. I'll continue. Tyson.
I think that AI, you have to look at two ways. I think that functionally, it can do a lot. And I think that the nature of ChatGPT and its ability to write, really is breathtaking. And I think that there will be a great deal of productivity that results from AI. There's a second question as to whether these stocks now have fully priced in the value. We can see the applications, but is that going to immediately translate to earnings for everyone? And I'm not sure how much all this free software is going to provide. And somebody pretty bright I saw recently say, well, look, it is just software. And the reality of it is, I think that it's a great productivity enhancement technology, but I think that the market action, to me, is bordering on irrational exuberance, though I'm not questioning the value that it can bring in varied applications going forward.
Fantastic. Great.
Yeah,
Mark?
and we saw this also with, the .com industry, right?
Absolutely.
Where we got ahead of ourselves in the 90s with everybody running out with business plans. And then, but if you go to the mid 2000s and you saw all these SaaS programs and things like that, they were all very successful. So maybe it's just the timing issue.
Yeah,
I think that the major problem too,
really well.
The major problem too is, remember when we had derivatives, that was a mystery, and the SEC didn't even know how to regulate those things. So fantastic. I can't see a Mitch McConnell trying to regulate artificial intelligence.
They can't get their hands around it. Sure. Yeah.